Good afternoon, everyone, wherever you are joining from, and welcome to today's webinar, which promises to be an impactful discussion on an important subject in recent days. My name is Evan Sassari. I'm a partner in the Deal Advisory Unit, KPMG West Africa, based in Ghana. We have a panel of experts to help us navigate through this important topic, from panic to profit, tariffs' impact on valuations. Welcome, and we hope you enjoy this session and contribute as much as you can. By way of agenda, we would have an opening remarks from Heather Caswell, who is a partner and head of valuations in KPMG Africa. She will give us the opening remarks, and this will be followed by a presentation from one of our partners, Wole Adelokun, who presents on the tariff impact from a global and Africa perspectives. And then after that, we would have a presentation from one of the key leaders in the business community, Rashid Sarumi, who will give us some perspective, a practical case study on tariff impact. Rashid Sarumi is the group CEO and managing director of Saro Africa International Limited. And then we'll have an insightful discussion from David Brown and Bolahan Ashagbe, who will present on the tariff impact on business valuations. And then Bolahan will come back and give us some conclusions. And then we will move straight into questions and answers, Q&A session, after which Heather would come back and give us some concluding remarks. We would like to request everyone to drop your questions, your comments, your observations in the chat room. And we will deal with these comments and then questions at the end of all the presentations. Also, note that we would be running some polls in between the presentations. And therefore, we ask that everyone would participate actively in these polls. After which we would have some discussions around the key outcomes of these presentations. We would now invite Heather Caswell to give us the opening remarks. Heather, please, you can take it over.
Thank you so much, Evans. I'd also like to welcome everybody to this exciting webinar, and good day to everyone joining. It's a pleasure to welcome you to today's insightful webinar titled From Panic to Profit, Exploring the Impact of Tariffs on Valuation. Trade policies and tariffs have always influenced global markets, but their effects have become increasingly pronounced in today's interconnected and volatile economic environment, especially in the last few months. As business leaders and valuation professionals, understanding how these shifts affect business value is not just strategic, but it's absolutely imperative. Tariffs can impact business performance, putting pressure on earnings margins and heightening exposure to operational and market risks. From my perspective as a valuations practitioner, 4 immediate questions come to mind. Firstly, how do you forecast in this new environment? Secondly, how do you adjust your discount rate to take into account this heightened level of volatility and uncertainty? If you look at a market multiple approach to valuations, how do you estimate maintainable earnings? What is maintainable nowadays? And finally, how comparable are the multiples from other countries, potentially with different tariff regimes? Today, we bring together thought leaders and experienced professionals to discuss how organizations can ultimately turn the uncertainty associated with tariffs into value. As Evans has highlighted, we have exciting speakers. Rashid from South Africa has experienced firsthand the effects of tariffs, and we look forward to his valuable perspective on navigating these challenges. David brings extensive consulting and training experience, particularly in building financial models for a diverse range of clients. I look forward to what he will share on his insights on how to incorporate the impact of tariffs into revenue forecasting and cost modeling. Wale will also draw on his deep experience in business strategy, economics, and national reform to discuss the broader implications of tariffs on both the global and African economies. In addition to moderating the discussion, Evans will also provide his perspective on how tariffs impact valuation, and Bolahan will delve into the technical aspects of how tariffs affect valuation inputs, including free cash flow, discount rates, and terminal growth rates. I look forward to the perspectives that will be shared by our valued speakers. So let's get started.
Thank you very much, Heather, for the opening remarks. We would invite Wole Adelokun, who is a partner, strategy and customer solutions, KPMG West Africa, to give us some perspectives on tariffs impact from a global and Africa perspective. Wole is a strategy expert with extensive experience in corporate and economic blueprint development. He's led strategy articulation and transformation projects across key sectors, including engagements with the NSIA, BPE, NMDPRA, BOI, and the federal government, supporting national reforms, performance frameworks, and institutional repositioning. Wole, over to you. Thank you.
I am sorry, Wole is not available at the moment.
All right, thank you. Then we would quickly move on to the discussions around the impacts of tariffs on businesses, where we'll have a practical case study to be delivered by Rashid. Rashid, if you're ready, we can have your presentation.
Evans, I am ready, but really I don't have a
So
presentation.
let me read a bit of a profile of Rashid so that we know who is going to give us this presentation. So Rashid Sarumi is the group CEO, managing director, Saro Africa International Limited. He previously served as a pioneer managing director of Saro Agrosciences and is a graduate of agricultural engineering from Obafemi Awolowo University. He is an alumnus of Harvard and Lagos Business School. Rashid, over to you. Thank you.
Okay, thank you for having me. And my role here is just to share my experience, and I'm going to use one of the industries where South Africa is a participant. And the industry I'm going to use is cassava. As we all know, Nigeria is supposed to be the highest producer of cassava, producing over 40-something million tons of cassava. And the challenge over time has been to get improved yield, but most of this cassava is used for consumption, as we have in sub-Saharan Africa, be it in Ghana or Nigeria and other countries up to Cote d'Ivoire and the French-speaking West and Central African countries. But the challenge over time has been to also push cassava for industrial use. And in the last 5 to 6 years, we have seen the development, more action in this regard. For your information, cassava can be used to making cassava flour, starch, sorbitol, which is the raw material for toothpaste. It can be used for ethanol, both food and fuel grade. And of course, the food grade can further be processed to consumer products and used in other industries. The challenge with this industry is largely that most of these derivatives of cassava, they are currently being imported into West Africa. And the challenge is being that where the products are imported from already have huge advantage in the sense that, one, they probably, if the products are made from cassava in the first instance, they probably have a higher yield. And if it's made from other feedstock, they probably have a higher yield. So leaving West Africa a disadvantaged producer. But Tariff is meant to balance this out in ensuring that local capacity is developed and cassava being grown is used for beyond local consumption. So the challenge in cassava to ethanol value chain is there's an import duty and there's an import levy, which is called the import adjustment tax. Unfortunately, most of the importers have lobbied in ensuring that the import adjustment tax is not applied, thereby making the local producers hold the short end of the stick. And in the past 10 years, I would say that over $250 million in Nigeria has been invested in cassava processing, maybe 350 million, and in cassava to ethanol alone, we're talking about maybe close to $200 million. The other challenge is where the ethanol is coming from. Maybe if it's coming from Brazil or Pakistan, it's not made from cassava, it's easier, right? And it leaves the local producers disadvantaged. Of course, this would have impact, on the business environment, ability of the business to grow, ability to when you import, you export jobs, right? Ability to have high quality job in the value chain to create a local or regional cassava processing economy where skills and competence would be further developed, and where companies in this sector would also be able to meet their obligation and deliver on their shareholders and stakeholders' expectation. That's one practical example I would like to share on the impact of tariff in the cassava value chain. We also have examples in the edible oil industry across the whole of West Africa where products are imported at lower tariff rates that is making local production a disadvantage, even at times where withholding taxes and local VAT are not charged on import, maybe if they are in a free trade zone, as we have in Ghana and co. So these inconsistencies in policy implementation, it's a major challenge for industrialization in West Africa. I think I would want to pause for a moment to see, if Evan still wants me to go ahead and talk about other issues, or if this is clear enough. Thank you, Evans.
Thank you very much, Rashid. So talking about policy consistencies across West Africa, and I heard about over $250 million invested in the cassava value chain. Are there any other, you mentioned edible oils, are there any other areas you want to talk about, any other perspectives from your
Yes,
experience that you want
the
to
edible
share?
oil is
Yes.
even the edible oil industry is much more bigger, right? Because in terms of investment, so West Africa and Central Africa, by nature of our food, edible oil is part and parcel of it every day. There's nothing you eat in West and Central Africa that you will not use edible oil. That's it. And I know in Nigeria, for example, the import gap is close to, is anything between 750 million US to $1 billion US yearly. And we have that. What makes edible oil a bit different is the byproduct of edible oil too is a major industrial raw material used, either you are making noodles, you are making biscuits, all sorts. You are making, big industries, they use this. And we also have these imports from Malaysia and Indonesia that comes at a lower tariff because the way the tariff is structured. The tariff, you pay low tariff in Ghana, 5% on Olaine, which is like the refined product. There was so investing in backward integration that has a payback of 13 years in Ghana, for example. Why should I do that? Right? So these are some of the issues. Ditto in Nigeria. Nigeria does have some kind of protection. However, this protection itself is not also uniform. But we are already working on an industrial policy that will ensure that there's uniformity of this tariff that will not aid export of jobs from West Africa and import of poverty. That's it. Thank you, please.
Thank you so much, Rashid. So just before I let you go and then we move to have you had any impact from any of the Trump tariffs? Okay, are you exposed to any of that? I mean, what has been the experience?
Indirectly.
Yes, right.
So when Trump tariff came, the oil, I'm not talking about crude oil now. I'm talking about oil for consumption. It's traded internationally, and most of it is coming from, I will use crude palm oil, for example, from Indonesia, Malaysia, lost close to 25% of its, prices came down as a result of Trump tariff. And the challenge is when you look at West Africa, where the government wants to encourage local production, these are long-term gestation investments. And all of a sudden, having such price movements, right, was very negative. Now, prices have stabilized, but they've still lost that 15, 18%, not minding the suspension of the Trump tariff. So indirectly, we have been affected because most of the agricultural produce, remember, are still traded internationally, right? So there is a reference point. So the Trump tariff kind of caused that implosion in the CPO prices that is calling to question our long-term investment in this space, and also being able to attract additional investment, not only from my group, but from other companies willing to fill the import gap, create more jobs, and deliver food sovereignty for the sub-region.
Thank you so much, Rashid, for these perspectives and all the issues around harmonization of tariffs and then making sure that we don't create jobs elsewhere and import poverty into West Africa. Thank you so much. We would now take the presentation from Wole, who would give us some perspectives on the impact of tariffs on businesses from a global and Africa perspective. Wole, if you're ready, please take it over.
Okay, good morning, everyone. Thanks, Evans. Please confirm you can hear me.
Yes, I can hear you loud and clear.
Okay, thank you. So I will quickly walk through the impact of tariff on global economy, and then quickly dovetail into what will be the impact on businesses. So the first thing to do is to try and look at what has happened in the past from a historical perspective to be able to unpack, the impact of tariff on global economy, and especially looking at Africa. So if you can see very clearly, the slide that is being shown on the screen provide insights on the trends of US average tariff eras and periods. But I will focus more primarily on the first period when we have President Donald Trump. You can see on the slide post. Now, what happened during that point here? I think first thing to take away is to stay always try to understand what caused things like this will always happen. Period. Now, on the next slide, part of the 2018 trade, world merchant trade volume actually fell from 4.6 in 2017 to 3% in 2018. And then further, as you go into the future, it also dropped further to 2.6. So that's the impact that came through. So it had a negative effect on the global economy, on an overall, on global trade on an overall basis. From a period where you have a 4.6, it moved further to 3.0, and then you have 2.6. When you look at the impacts on global growth, the global growth actually declined from 2.7, in 2000 and, from 3.45 in 2017, it declined to 2.7. So that demonstrates, the various impacts. When you look at on the African economy, we're able to slightly, stay ahead, and we ended with a 3.5. But if you then do a further deep dive to understand more the various impacts of the various era on the African economy, on the next slide, we try to paint that picture of the various regime that has been in the US. So the first is, what is the impact in terms of trade? The second is, what is the impact in terms of foreign direct investment flow into Africa? As you can see on the screen, it was very clear that during the Obama era, we had a growth that in terms of US trade with Africa, it was slightly ahead. You have $64.8 billion. When you look at sub-Saharan Africa, you had $46.7 billion. Then in Nigeria, it was 9.8. But when you come to Trump era, the first era, it actually declined. Whether you are looking at it from an African point of view or sub-Saharan Africa, and then you move down into Nigeria. Then we after that era, we had the Biden era, and you can see an increase. Now you can argue that, maybe the impact of COVID also has some impact, but if it has some impact during the Trump era, but the data also demonstrate that trade actually dropped beyond the impact of the COVID, is also driven by the tariff issues. Then when you go further down and you look at funds flowing into Africa to actually drive businesses in terms of foreign portfolio, foreign direct investment, it also witnessed a negative decline of about 3.4%. Now, taking the conversation further very quickly, what are the likely impacts? So model has been done and we've seen what the impact will be. On the next slide, it shows that there could be possible slowdown in terms of growth due to higher cost, lower consumption, and investment. So that could have negative impacts. Now, for export-oriented economy or businesses, it is very clear that there could be negative impact. So your ability to look at other, trade allies will be extremely important to navigate that. Inflationary pressure also could increase, because higher tariff leads to higher import prices, pushing up inflation, especially in countries that are import-dependent economy. So it then means that if some of your input material, are import-dependent, and some of those things may be subject to an impact, whether from a tariff or a multiplier effect, you must be thinking about how to diversify, your supply source is extremely important for businesses. There could be fall in global, in terms of global trade, as well as the supply chain disruption. Currency volatility is another thing, and then investment uncertainty and setback in terms of productivity. When you dimension the impact further, whether from an economic impact or market reaction, is actually demonstrating some sort of negative. Now, quickly, when you come to Africa, from an African point of view, we've also tried to dimension what will be the likely impact. Number one, there could be impact in terms of slow demand for African export for those that may be impacted by the tariff, higher inflationary impacts, and then for countries who actually are dependent on export aid and FDI, they may record some slight of decline in terms of the growth. There also be some pressure even from a fiscal point of view for government, and then that may impact ability to also support businesses or provide environment to support businesses. The other thing also is that the competitiveness of African economy also, there's an advantage that comes there. So it's not only a negative effect, but there's an opportunity for Africa to benefit from that global supply chain reconfiguration. Which regions are being affected? Where can we actually look for allies in terms of pushing our product to the market? So you could also even increase trade within African countries. So it's not only actually a negative impact, there's also an opportunity that we can actually tap into. The final thing I would like to say is that as we reflect on this, you must be able to dimension what would be the impact from an operational point of view, from a tax compliance point of view, and then from a corporate governance, which is what is reflected on the next slide, what it means for businesses. So what we've done is to try and simulate what those impacts will be across operation, tax compliance, and corporate governance. Next slide, please. On that slide, you will see the impact has been defined at 3 levels. The first level is, would it be a significant business-wide impact? Will it be a functional lens or a limited impact? So what we've seen is that I will focus on the one that speaks to significant business impact. Number one is the supply chain, this network that may be significantly impacted, as well as your channels to markets and sources of supply. So it's extremely important to define a strategy to mitigate that. From a tax compliance point of view, you must be able to model what will be the impact in terms of quota as well as the tariff. It's important to look at that and define an immediate impact. A planning scenario as well as strategy also may be impacted. That needs to be considered. So finally, as we think about this, we must, as business, be trade alert. We must be able to reassess, our supply chain, resilience. We must be able to strengthen contractual, obligation, protect ourselves against any risk, reevaluate suppliers' agreement with focus on tariff-related risk. It's important to introduce or review, clauses that could address tariff volatility is important, and define mitigation strategy. And finally, enhance custom valuation and trade compliance. These are the things that are important. As I close, it's important that I want to leave us with this quote. And that quote is extremely important as we go into our conversation further. The role of leadership in business today is to bring clarity in uncertain times. We have an era where global uncertainty has become very heightened from a trade point of view, from a geopolitical tension, from even trade, from wars between, various countries. So we're living an uncertain time. So the more uncertain things are, the more leadership is required. There is no job description for what you are facing, no rule book. Today's leaders need to strive in the face of uncertainty. Thank you for your attention. Evans, back to you.
Thank you so much, Wole, for this insightful presentation. Are you available for just a quick question before we let you go?
Sorry, I may need to go.
Sure. Okay. All right. We'll see if any of the panelists would handle some of the questions that may come after this. Thank you so much, Wole. Just to also announce that if you have any questions, any observations, please drop them in the chat box. Otherwise, after these presentations, there will be a whole Q&A session where you can put your questions to any of the panelists here. Thank you so much, Wole. We would move straight into the next presentation, which is really more of a technical discussion, okay, on the tariff impacts on business valuations. We have a panel of two seasoned experts in valuations, David Brown and Bolaha Ashagbe. David Brown is a renowned financial modeling expert and a data analytics strategist with over 25 years of experience spanning Africa, Europe, North America, and Asia. He has built frameworks which have become industry standard in the fields of advanced analytics, financial modeling, and productivity solutions. He is the founder and managing partner of D. Brown Consulting, a leading analytics and training firm based in Nigeria, and CEO of D. Brown Analytics Solutions, LLC in Dubai. He has consulted for global organizations providing unique solutions to data challenges. Also on Bolanhan, who would also be a co-panelist. Bolanhan is an associate director and head of valuations, KPMG West Africa. He leads the valuation advisory practice in KPMG West Africa and previously headed the valuation team in another Big Four organization. He has 14 years of experience in valuation and advisory services. He has delivered independent valuation across diverse sectors, including financial services, technology, oil and gas, and consumer markets. May I have the pleasure to invite Bolanhan to take over, which David would also continue. Thank you so much.
Yeah, thanks, Evans. So I'll take from here. Okay, I think both speakers, right, they've discussed at length tariff announcements, the measures, and how these have impacted the global market and overall its economic growth as a whole. Even though there's been some reversals or some stabilization around the tariffs and some are on hold, the past few months have revealed that businesses and investors need to understand how current and future tariffs impact valuation. When you look at African countries, we've been largely, kind of like the impact. There were two case studies that we saw. One is Rwanda in Nigeria. As soon as tariffs were announced, there was a decline in share price by like 3% between February and April. But as soon as there was a pause on that tariff, the share price rebounded by like 19% within 2 days. The other one is Combat Iron Oil in South Africa. Their share price reduced by like 17% between February and April during the wave of the tariffs announcement. Even though while tariff announcement may not be the sole drivers of share price movements, notable shifts in pricing reflect investor reactions to trade policies, particularly for export-oriented businesses. And we can also, even within the US itself, the likes of Nike and Apple, share price actually dropped since the tariffs were announced. And so that takes us to technical aspect of it. That how do you approach trying to value a business impacted by tariff? I think the right approach, I mean, the recommended approach would be the DCF. And in there are two key areas that you need to consider when you're looking at DCF. One is around the forecast itself. Forecast needs to reflect the short to medium term view, i.e., because tariff itself can reduce sales volumes by making goods less competitive. And as Mr. Sarun mentioned, it can also impact prices as well. You also need to invest in local productions or find alternative supplies to avoid tariffs, taking a cue from what Wale presented. You also need to look at your supply chain and make some changes around that, which may increase your inventory level. That means you're holding on to inventory longer than what you had before, and extend your work capital cycle days. That's for the forecast. Those are the kind of conditions you need to think about. On the income, on the technical valuation part of it, the businesses that are impacted by tariff, there's likelihood that the provider of credit or debit, or debt may demand higher returns from export-oriented businesses that will be impacted by tariffs, i.e., the kind of like interest rate you're looking at on your on your loan kind of like goes up because there's that passive additional risk facing, and it can also increase the business and market risk itself of where that company operates, which may cause key discount rate components such as or returns to fluctuate. So how do you deal with this? Recommendations. You start asking yourself that question around, i.e., risk rate. Do I want to use a point estimate, which might have been influenced by the turmoil caused by the tariff? Or do I start looking at consider historical average, maybe a 10-year average or median? That helps you kind of like take out the noises created by the tariff and gives you a view of where you think the risk rate of that country lies into the long term. Because when you are looking at discount rate will be used to discount the business forecast into perpetuity. So you want to use the key inputs that reflect what that country looks like in terms of risk rate, what the beta looks like. And so for beta itself, you might want to start considering longer term beta, 5 years and above beta data, which should also have taken care of what are the turmoil that is happening in the market and how the share price is reacting to the volatility in the market itself. So you are looking at a long-term beta rather than a one-year beta. Then you might also start thinking of, do I need to consider adding an alpha to the discount rate, especially for businesses that have been negatively impacted by tariff exposure? So those are the key considerations you might be thinking of when you are using this year. For the market approach, we've all, from what we've said and everything, we found that tariffs news can cause temporary swings in trading multiples. You saw that in the US stock, the US exchange and the rest, whereby there was this massive swing up and down on the share prices, which will most likely impact the valuation multiples. And what we found out is initial market responses to tariffs may sometimes be exaggerated, inflating or suppressing multiples temporarily. Then also, you also start looking at the base itself of the valuation itself. For the market approach, you are looking at is the valuation multiples against the earnings base. So you also want to look at it. This current earnings I'm looking at, has it been impacted by additional costs around to fix your supply chain, or has the company benefited from tariff changes itself? So you want to start asking yourself that question around. Okay, fine. How do I get to an earnings base that is sustainable into the future? And so the recommendation around that is that when you are looking at comparable companies, you know what comparable companies is? Because when you're looking at comparable companies, you're basically asking yourself that question: how are these companies comparable to the target I'm trying to value? If you start thinking around, do I look for businesses that have similar supply chain structures and geographical reach and tariff exposures? So that means what that means is that you're actually using companies that are really comparable to the target you're trying to value. And if I'm looking at transaction multiples, it makes sense for you to separate them into pre-tariff and post-tariff, for you to observe potential trends, whether this particular industry has been, is immune to, or there's a change during the pre and the post tariff period. Then when I look at the base of the valuation multiples, those are the earnings. You need to carefully adjust or normalize when necessary. For example, if a company was previously impacted by tariff-related costs that have since been reversed or suspended, or you don't think it's going to happen to you, appropriate adjustments should be made to reflect a more accurate earnings that is sustainable and normalized. You also need to ensure that valuation base reflects sustainable earnings for the business being valued. I mean, those are the major considerations when you're looking at valuing business from a DCF point of view and from a market point of view. I think for me, I'll leave it to David to expand more around what are the things you need to consider when you are trying to model what the numbers would look like for a business that is impacted by tariff, what the numbers would look like, and those are things you need to consider.
All right. Okay. Thank you very much. Bolahan, can you hear me? I hope I'm clear.
Yes, David, we can hear you.
Okay,
Please,
great. So I'll just share a few slides. Let me see if you can, don't know if you can see. So I'll just go back into technically when people build models, right? As in tariffs affect nearly everything. So what I'm going to do is I'll show you generally a short version of a framework, a typical modeling framework, and let's see what it affects. We have this DAPA model framework. For those modelers in the house, you want to start building a model. Obviously, you have to have tariffs in mind when you're building these models, and it's going to affect nearly every single assumption. First thing, of course, you're going to define your scope and objectives for building this model. Most times you're building the model to kind of get what value is, what's the value of the business. And in fact, I'm going to start off with that value discussion. What really is value? And Bolahan touched on many of the aspects, but typically value just hits on three things, really: cash flows, growth, and risk. So cash flows, growth, and risk, which is kind of encapsulated in this formula, this famous formula that we use a lot, which takes on the net operating profit after tax. So you have your cash flows for the firm, free cash flow to the firm. This is what you're calculating. You start off with that net operating profit after tax. Now, obviously, you will need to have a return on invested capital. That return on invested capital, depending on where you are on the tariff. Anyway, for tariffs, really, I wouldn't say depending on where you are. It's a fail-fail. It's a lose-lose. Tariffs are really lose-lose. But the benefits of tariffs typically are okay when you want to kind of build up your local industry. But in the meantime, people are losing. Everybody in the economy is losing, and your suppliers are losing while you're building up your local capacity. But value really is your cash flows, which we'll have as no part here, and then your growth and your return on invested capital. And your return on invested capital with growth, and then your risk, which is your weighted average cost of capital. And if you notice here, for those that really don't know this formula, you have growth at the top and growth at the bottom, because growth costs money. For you to grow, you need to invest. So you need to invest on your return. That's how you get your return on invested capital. But investment here, the cash for investment, a lot of it is going on tariffs. So it's kind of messes up with this formula and messes up with a lot of things as well. So how do we model this? How does this affect our models? So again, we have to define the scope of when you're building a model, doing evaluation, you build a detailed financial model, forecast strategy, you need to have tariffs in mind. So that's part of the objective you have, okay, in the times of tariff, right? Then part of the DAPA approach, your framework for modeling, you need to acquire and cleanse a lot of data. This will also involve probably when we look at line items of your financials that I'm going to show you, you may decide, look, we need to get source supplies elsewhere. Sourcing supplies elsewhere adds additional costs. There are additional filings and stuff that you need to do. Then you need to plan and structure your model based on all of these tariff-related issues. You need to change the structure of your model. Then you populate your core calculations after doing all that research and planning, and then you evaluate, validate, and stress test. There's going to be a lot more stress testing in your models. You may even need to do some Monte Carlo simulations, right? Kind of do loads of simulations within the various tariff bands to see how that affects your outputs. And then, of course, you do your reporting and analysis and outputs too once you finish your model. So that's just the framework. Let me go into a little more detail now. So this is the model framework that I've kind of presented. This is a more fuller version of it. I'm sure we'll be able to share these slides with you. And what about the actual line items of your P&L or PRL? So we just created this, and I've been listening to Mr. Sarami, as he was talking, and saying, okay, so what about revenues? Are we more domestic or export? So domestic, you still have higher input duties, you have higher costs, you have potential price hikes. So you need to keep the tariff pass-through percentage. You have to have a tariff pass-through built into your model. And the key thing about tariff pass-through is who is paying. The most important thing for you is how elastic are your goods? How elastic are your services, right? Can you pass through those costs to your customer? Or do you have to kind of bear some of it? I'm sure we'd have to bear some of it because competitors too are trying to gain market. And the key thing there is how do you drive costs down? So it's revenues, yes. Can you increase revenues? Can you pass through? You need to model that and see what pass-through percentages you're going to put into your model. You need to split sales into export and domestic. For exports, there are other challenges as well, all the export duties and stuff. So you have tariffs coming in. And then I don't know if there's reciprocal tariffs going out. Again, you need to model that. Cost of goods, all your export duties, export duty percentage, you need to have that kind of increase. You have a switch, a general switch, so you can tweak that and do some sensitivity analysis around that. Freight and logistics, again, you probably add a kilometer weighted freight cost per ton. Driven by an export route factor. So which export routes are you taking and what are you doing to kind of avoid tariffs? Are you having to go further out to bring in raw materials? What's the additional cost compared to your previous cost? Is it lower than tariffs? You need to do all those modeling to kind of understand what to do in that tariff regime, right? SG&A, trade compliance, you need to layer fixed headcounts, advisory fees, fees triggered when either import or export duty tariffs are triggered, right? So you need some switches in your model. Operating costs, of course, taxes are also going to be affected at the end of the day. Everything is affected. Even balance sheet would have some key items. Your inventory, for example, you have to lengthen finished goods days when exporting due to tariff shocks, right? So you need to kind of account for all of this. Obviously, working capital will be an issue. You need larger working capital. You obviously need higher financing. So it affects basically nearly everything. So this is just a quick kind of summary of what would be affected and how your planning for your models need to kind of be significantly updated for you to be able to take account of these typical tariffs. So your typical model, I mean, would have all those switches, adjustments to your model, but your structure of your model won't change as much. The key thing for you is to be able to create switches because this is an uncertain time, and then run a lot more scenarios. So you need to run quite a lot more scenarios to be able to handle those tariffs. You need to do a lot more model auditing. So you probably need to adjust your model audit section just in case you make mistakes around that. And of course, thorough reviews. So tariffs, I mean, the people that would win are the people that, one, have very elastic or inelastic products that they can pass through these additional costs to their customers without losing much revenue, or you just need to significantly cut costs. It's either one of the two. There's no middle ground there. Cutting costs significantly, or if you're lucky enough to be able to pass through to your customers. So that's a quick summary. I would obviously be happy to answer questions when they come through. Back to you, Evans.
Thank you so much. So would like to invite Bolanha to give us some concluding remarks. I think David can stay here, and then if there will be some, conversations around this. So thank you so much, Bolanha and David for these insightful remarks on the technical side. And I like the point you made about how elastic your product is. We know one of the strategies that businesses are using is to stock up, quickly before even the tariffs, come into effect. How would this even impact working capital? Because you need to, have a lot of, inventory ahead of the tariffs coming in. I'm sure it would have some impact on the way you even calculate working capital in your valuation or DCF model. It would be nice to have some commentary around how, you adjust for any of these stocking up that businesses will do before, the tariffs set in. So, Bolahan, you can take over if you're ready.
Okay, yeah. Thanks, Amos. So I think so. I mean, we've heard from Wale around the macro bit, talking about the the various US presidents era. Now and giving us a pointer to what we should expect, even with that data yet. I've also heard from Mr. Sarami around the practical case study around tariff has impacted the business directly and and indirectly. And we're also taking a cue from that around why it's important to get that. I mean, why DCF is the preferred approach around when you're valuing business or trying to think of valuation of the company, and why very important is to get the forecast right that shows the short to down view. David has pointed out the key considerations you need to think to around value driver of that model. I mean, from the how elastic your product is, the tariff pass through around that. We've also talked about around the cost as well, and also mentioned how you rerouting your supply chain or trying to stock up will impact your modeling, which has a negative impact on valuation. But what that basically means is that from a DCF point of inventory, that is cash outflow. And what that means is that as you need to fund that, and that impacts your free cash flow. I mean, at the end of each year, and that will impact your valuation negatively. They've also mentioned what are the key considerations you need to consider when you are looking from an income approach point of view, DCF. Around the inputs around the discount rate. Why is risky now to just is advisable to putting out the volatility or the noise from tariff? And if you are doing market approach, why is now very important for you to think carefully around your comparable companies. Look at the ones that are supply chain issues, and as compared, you separate that into the pre-tariff and pre and post-tariff to just see if there's a trend or whether it's different and what to use, and also how to normalize the earnings base from market approach point of view. So those are the key things that those are the key things that I think you need to just think through and when you're valuing businesses from businesses that have been exposed to tariff at a negative or or positively. David, John just talk about around how you will what are the things to look out for when you're addressing the questions that Evans raised around the work capital.
Yeah, so obviously we need to be smart. And let me say something about us in Africa, right? Or maybe I'll talk more about Nigeria. We've been having tariffs for a very long time. Let me give you one that we've had, massive one. Exchange rate. Our exchange rate has moved from what? Maybe 300 or something to 1,700. To me, that's a massive tariff. Why is that a tariff? Your naira basically cannot buy those same raw materials. They've gone up by, if it's 300 to 1,007, how many percent is that? Like what, 500%? And we are still here. You wonder how on earth we do it, right? So at the end of the day, of course, incomes haven't gone up to that level. And here are some tricks some of our manufacturers use. I don't know, let me use a simple one everyone will know. If you look at the water bottle, so if you look at the water bottle, right, those plastic water bottles, at some time in the past, right, they were very sturdy, very, very sturdy. So the amount of plastic used to actually make those water bottles has been significantly reduced. They probably cut that cost in like a quarter of the cost. And do you know what they do in the replacement? They put some pressure. After you fill it with water, you pressure it with gas as this particular, I don't know if it's carbon, CO2 or something. You pressure that thing. So it's now sturdy based on pressure, air pressure. The moment you open it, it's kind of like not the same, isn't it? So there are creative ways to cut costs.
Yeah.
Because that is very inelastic. That's water. I mean, at the end of the day, if your bottled water goes up by 200%, forget it. Yeah, you lost your market, right? Because that market is kind of elastic in a way. So you can pass through all those costs to your customers. So there are various smart ways you could do to cut costs down. Artificial intelligence is here now. You need to start thinking very creatively on how you can use artificial intelligence to significantly cut costs down, right? And I think that would affect us, our own business or service businesses, right? Because we're also affected by these tariffs at the end of the day. And there could also be positive effects. Why could there be positive effects? because these costs, assuming certain companies abroad are spending their money probably in Malaysia, or they're buying services or offshoring services to India and other places, and we have a lower cost base. Obviously, people are going to move to a lower cost base. So with a lower cost base like Africa, people will start looking and saying, look, let's cut costs. Cut costs is global. Where can I cut costs? So it's not all negative. There's still some kind of positives there, and you could even be more competitive when you have tariffs. So we have to think creatively. We have to have a very global mindset on how we can solve these problems. And I think a lot of companies in Africa, Nigeria in particular, are doing an excellent job of cutting costs and then finding where they can actually make gains by exporting their cheaper products and services to more global markets.
Okay.
Thank you so much, David. Thank you, Bolanhan. I think, David, your point on exchange rate being a tariff is really, resounding in this discussion. I mean, somebody also confirmed that, David, your point, devaluation is a tariff. So it seems that it is something that people haven't addressed their minds to, and it is across West Africa, Ghana, not exception. We still have the polls running, and if I may just announce what we have so far. So we have about 94% of our guests from West Africa and 4% from Southern Africa. In terms of the question as to whether they have already seen tariffs impacting their businesses, 58% say yes, tariffs have impacted their businesses. So at least we have more than half of our audience having experienced the impact of tariffs on their businesses, and then 42% haven't seen any impact on their businesses yet. But viewers, please, let's all try and put our questions in the chat room. There'll be a Q&A shortly. If you have any question, please just post it in there, and then we would deal with all the questions and all the comments that have come up after after this section. So please, if you have any question, please just post it in the chat room, and then we'll read it out for the panelists to address. You can indicate who you would want to address that specific question. Otherwise, I will direct you to the panelists that I feel will be in the right person to address them. So please, thank you so much, David and Bolanhan. We would now move straight into our Q&A. So just probably to start off with, whilst we wait for our guests to put questions in the chat room, I'm still monitoring the chat room. So 62% in terms of the polls, 62% confirm that tariffs have had impact on their businesses. David, you mentioned that it is not all dark and gloom, that it is always, a negative impact. There's always some positive impact also of tariffs, but it depends on which, side you are on. I mean, some see it as a protectionist, to protect local industries. And then the importers and exporters also have issues with, the industries. In Ghana, we have similar situation where we have some kind of a debate between the Association of Ghana Industries, who are manufacturing locally, and then the GUTA, Ghana Union of Traders Association, who are importing and exporting. How do we navigate such a fine line? We draw a balance such that we don't impose tariffs to hurt those who are importing in order to protect manufacturers, but we also ensure that we also open up for those who want to import or export to do trade across the various regions. So, David, any thoughts on this? How do we draw this balance? Okay.
So to me, I think it's all policy, right? So policy, everything about policy, the policies that actually work are policies that understand incentives. So it's incentives that drive everything, right? So the economists are the ones that really know this, right? So what incentives do we have? Take Nigeria, for example. We've had the exchange tariff that I want to now start calling it, that has significantly reduced the value of the naira. What does that mean? Nigeria is superbly competitive now. Nigeria is so much more competitive than it was 3 years ago, again, than India, than anywhere else. I mean, take offshoring, the call centers. I think Ghana, Nigeria should become the call center hub of the world because of these tariffs and because of this devaluation. I mean, English is usually the major language for call centers globally. We speak English reasonably well. We are far cheaper than maybe Philippines and India, who are the leaders when it comes to most of these offshoring services. So what is the policy of governments, right, to take advantage of this fact? And I mean, our educational system and stuff. So you could see that, I'm sure you understand that there's already a big opportunity there. But the infrastructure, unfortunately, is not up to standard. As in, we've had internet issues right now, for example, our bandwidth and stuff. So it needs a significant boost on policy. It needs a significant boost on how do you support people that are building massive call centers? How do you support people that are building? Because when it comes to tariffs, we always think of goods. We straight away we think of goods. We think of goods, products, exports of products, not necessarily services. So I think we should also take our mind broader and look at services as well, as can we really export major services as a result of these tariffs and us being a significantly cheaper alternative for people that are chasing, looking for cost reductions. I think that's a big plus for Africa.
Thank you so much for that response. We have a few questions, so I'll read the first one out. So how do businesses typically respond to a tariff hike? 2, what is the inflationary impact of a tariff hike? So probably I would direct this, if Mr. Rashid Sarumi is around, if he can take a bite at this, and then we can have some perspective from Bolanha. Is Rashid still with us? Hi, yes, I can see you now. So the question is, I mean, you are a business, so how have you responded to tariff hikes? Okay, if it's had any direct or indirect impact on your business, and has it had any impact, on, inflation? What's been the what extent to which has it, influenced price hikes as well? Hi, Rashid. Yes. Yes, you can go ahead now. Yeah.
Sorry, I didn't quite hear you properly.
Okay.
I
So
had a
the
problem
question
with
is
my
that how
system.
do businesses respond to tariff hike? So you've given us some exposition on how your business is impact. How have you responded to it? And then to what extent do you think it might also influence inflationary pressures?
Oh, I mean, changes in tariff, if it's higher, it all depends because I'm a local producer, right? But generally, when you have increased tariff, it's a direct hit. It's going to affect inflation, just like the valuation of stuff. But where we have tariff misalignment, because several of the businesses in the agri value chain requires, long-term gestation, so what we have control over is our cost, quality, and stuff, right? So we have to have the capacity, and when we have good times, we also have to ensure that we have resources that could see us through policy inconsistencies or tariff adjustment. That's one way. But if those inconsistencies or high tariff, there is always a limit that we can manage through the difficult times, that we are able to get things under control. And that's why you've not seen several companies go into these spaces, right? And you're also not seeing Africa or West and Central Africa attract the right type of investment, right? And so it's a challenge that we have. And however, for us who are local, so indigenous to this sub-region, this is our geography. And it's incumbent on us, though we don't run Red Cross PLC, right? It's incumbent on us to ensure that we work with the respective government, the policymakers, we make our voices heard, and over time, this is being done. Even beyond my industry, where we have seen in other industries in Nigeria, and in Ghana, in West Africa largely, where they were largely import-based, but over the last 10, 15, 20 years, where we are now net exporters, right? So it also presents opportunity. Thank you.
Thank you so much. So it's more about influencing policy. I'm sorry, David, did you want to make any comment? No. Okay. All right. So we have another question, which I would direct to Bolanhan, and probably Heta can also share some perspectives on that. Should we consider a scenario-based approach for our DCF analysis? And if so, what are the key scenarios we should model on? So this is from an anonymous attendee.
I don't
I
think
think that's for you.
Okay. Yeah. So I think everything still stems from, so it flows from from this year, it flows from the model itself. So if from your analysis of that particular company, you feel that some of these tariffs are not sustainable, we are not sure because of the announcement of 20% today, tomorrow I've given 90 days for you to negotiate and everything. So it makes sense to kind of like model those kind of different scenarios of what you think will happen if this goes through, or if you think it will reverse. So you end up with different forecast scenarios. Then based on each one of them, you can now have you can now have a valuation. You can now have a DCF valuation. So that way it gives you different data points. Like I say, fine, from what I'm seeing here is the valuation ranges from this to this based on different DCF scenarios that you have. So it still goes back to the quality of your forecast and how you see this tariff impacting that business and what you think numbers will look like short to medium term.
Sure. Thank you. David, you mentioned Monte Carlo simulation. I mean, as one of the, kind of sensitivities you may want to run. Would you want to give a brief, highlight on what are the key parameters to be considered, if you want to use some of these scenario modeling, approaches to valuation? Yes.
Yeah, so most of us, and when it comes to modeling, we usually have two categories like that. You have deterministic and then you have stochastic. So most of our models are deterministic, where we're just having straight line assumptions, right? We just have straight line assumptions. Oh, it's 20%, it's 13%, it's 15%. But in between those percentages, right, there are so many things that can change, right? So you would need to run simulations, and that's one of those simulations, like a Monte Carlo simulation. Give you a simple example. If you throw a dice, you probably will get 1 to 6, right? Between 1 or 6. The more times you throw that dice, it now starts getting very predictable what it is you will get on average for all those dice throws. So if you throw a dice 1,000 times, it now gets really a way you can really predict what you can predict. You can predict it in the sense that you can reduce the risk when there are many throws of the dice. Now, if you take your gambling companies, for example, you're gambling on Nigeria actually is a big betting nation. You need to take probabilities into account, right? What's the probability that Chelsea is going to beat Man U? Probably very high. I'm a Man U supporter, and I just don't understand what's going on there. So anyway, but those probabilities are what they look at, and they build massive scenario models to be able to predict what are those odds that they should put to the markets. And they make money. I mean, they make a huge amount of money. So I think it's important that we bring some of those skill sets into our models, right? And start running simulations on some really unpredictable things. This tariff stuff is unpredictable, right? And having point estimates, I don't think would work. So it's not that difficult. Excel and all these other tools can do all these simulations very easily now. We have massive, powerful array formulas in Excel now and stuff. So it can be done. It's not a difficult thing. Google Monte Carlo simulation in Excel. You see how it works between -5%, 5%. You need to know a little bit of statistics, standard deviation and stuff. You need to kind of bring that in to your modeling. Yeah, so that's what we take, really.
Okay, so I mean, so David, so it also stems from the quality of those input data that you have that the Monte Carlo simulation will run on. If you don't get that right, you end up with I mean, you end up with the wrong output. I mean, and that flows to the next question, which I think you should take around third question, which is around I mean, how do you forecast drop in volumes? Because those are kind of the things that key and I mean, if you don't get that right, you will end up with the wrong output.
Yeah. So forecasting drop in volumes. One important thing that if you're a modeler, you need to be very, very close to the business. Very close to the business. You need to know the salespeople, you need to know the marketing people, you need to feel the pulse of the business really well. So we're not sitting down typing numbers in our spreadsheets and thinking that's reality, right? We need to understand what's on ground and we need to start seeing trends. And not models now, trends in the real business. There are lag and there are lead indicators. What are your lag indicators? What are your leading indicators? So you need to start looking at leading indicators. We as modelers look at lag indicators, which is indicators something that's already happened, and then we're modeling. So what are those leading indicators that will tell you that something is shifting, right? You need to identify those leading indicators, and your operations people, your salespeople, your marketing people have those leading indicators. They know those things. So if you're modeling, try and start modeling those leading indicators, right? So you have, take for example, HR. You can't, right now it's so difficult for us to employ top people. Why is it so difficult for us to employ top students or graduates that really can take on appointments? Before, I think it was 100 to 1, now it's like 200 to 1. But there are leading indicators in our educational system. You see the scores, on SSC scores, you see the scores on university, you see all those leading indicators showing there's a downward trend in educational quality. Your model should be able to predict that cost of employment is going to go up based on those leading indicators, right? So there's a lot of work we need to do as valuers, as modelers, looking at the business themselves, seeing those leading indicators and knowing, okay, we can potentially predict things going forward. I was in a modeling training recently. We did a detailed ratio analysis, beautiful ratios, right? And they're comparing two companies. And the ratio for return on equity, whatever, was let's say 6% for one and 6.1% for the other. And they thought, oh, these are comparable. They are not comparable. I said, did you do a standard deviation of these ratios going back 10 years? Just a simple standard deviation. And when they did a standard deviation, you could see that one of the companies had a very high standard deviation, and the other one was pretty low. What is standard deviation? It's simply a deviation from a standard, and that standard typically being an average. So you already know that this company is high risk, even though the return on equity average for the last 10 years was 6%, and this was 6%. The standard deviation tells us a different story, that the risk levels for this company is far higher. So we need to bring in some more tools when it comes to our modeling and our valuations so that we can see, okay, what are those leading indicators that tell us what this company is doing and how we can then have better predictions going forward.
Excellent, David and Bolanhan. So David, just before I bring Heta to also share any experience from the Southern Africa practice on how tariffs are impacting some of the assumptions driving valuation. David, you also doing, analytics, data analytics and AI and what have you. How are we building up to, develop certain parameters or models that AI can help us in their predictive, analysis, and, some of these uncertainties can be, resolved using AI and any other, learning, machine learning methods.
Yeah. I think we're in a time where it's amazing. AI, just to summarize for everybody, you always hear, go and learn how to code. Go and learn how to code, go and learn how to code. And I think it's a thing I never did really, to learn Python and stuff. It was great. Why do you learn how to code? Because you want to be able to talk to the computer and get the computer to create things that you want. When the generative AI revolution started around 2017, computers have cracked what makes us human, which is language. That's the big thing about AI. Computers have cracked language. Computers speak English. So which means if I want to code, all I need to do is speak English to the computer and it will do the coding and give me my answer. So computers cracked what makes us fundamentally human. So now we can talk to anybody can talk to computers. And unfortunately, I see a lot of us are not using it as well as we should. This is a big cost. It's going to reduce cost significantly. Take advantage now because everybody else is also going to reduce their cost and we're back to square one. So quickly jump on this thing. And the way you do that is you need to learn prompt engineering. It's a fancy word for how to speak to a computer. And how to speak to a computer to get what you want is how you speak to your colleague to get what you want. It's the same thing. Just treat your AI as a colleague, right? There's a CRISP framework I use. I'll just quickly tell you what it means. You can Google it. CRISP framework for prompt engineering. First is context. You need to understand context in detail. Context, right? And context is everything, right? So you tell the next thing is R, which is role. So context and role. Tell the AI, hey, you're a top valuer. You're one of the best valuation experts in the world. You understand Trump's tariffs very well. You understand everything. You understand how it's going to impact you. Let's start discussions now. You've given it a role. You've given it the context, right? And then you need basically to understand how relevant, as in content, your context, your risk, your role, and then your instructions. So just like a colleague, you're going to give your colleague instructions. You need to give very detailed and clear instructions. It can be 10 pages of instructions, right? What it needs to do. Then you also need to tell it to be succinct, and you yourself need to be succinct. This AI has everything in its head. You need to tell it, hey, summarize the things well. So tell it to be succinct. And then P is practice. We need to keep practicing with it every day. There are risks around AI and security and all things around whether your data is secure. That can be fixed. Right now, I use ChatGPT, which means it's outside my network. You can bring that ChatGPT or Copilot or Google into your environment, and that way it's more secure. But we need to start thinking, how do we cut costs with these things? How do we significantly cut costs, make ourselves more efficient? And then tariffs may become an advantage at the end because they're a low-cost producer now of services and goods.
Thank you so much, David. Heather, any perspectives you want to share? There's another question in the Q&A room. I would read that to you as well. So any perspective on how you've seen the impact of tariffs on valuations?
I think it's really, for me, I go back to the title of this webinar that talks about panic. If you follow the news and you're seeing all the quotes about the coverage of the tariffs, it can lead you to feel that it's a massive panic. But as David has said, we've always had tariffs. And it also affects different industries differently. So it's not a one size fits all. Of all the valuations that I've been doing in the last 3 months since Liberation Day, I haven't really actually seen my clients making major changes. Either it's because they're focused on the local market, they're trading within Africa, maybe they were not actually exporting to the US in the first place. So I'm not actually seeing that there's fundamental changes being made to investment decisions yet or forecasts by my clients. We are seeing that in the US risk-free rates, they are higher, but they were also higher from when Trump started talking about higher tariffs, amongst so many other policy changes, we saw the US risk-free go up. But I think, if I go back to Walahan and some of the comments that he made on valuations, in a valuation, you're looking for the extreme long term, all the way into perpetuity. So panicking about something in a shorter term could be a complete overreaction, and you need to have a very long-term view. I've been doing valuations for more than 20 years, and there's so many events that have happened globally, and businesses carry on. And I think that for me it's just critical to keep a long-term view in mind and not allow yourself to panic and completely throw out everything that's already right with the business and assume that it's all fallen apart.
Thank you. So the topic is appropriate, from panic to profit. So don't panic. Just make sure that you do what you're doing right. You don't, change what is, it's not broken. Thank you so much, Heather. So let me read this question quickly out. So, sorry. You want to? Okay.
Yeah,
all right.
So the person mentioned, right, that if you've adjusted your volumes and code, in line with what you think will happen. I mean, the alpha is just the alpha is to just considering whether you have. I mean, if you're able to model the changes or the impact in your model, then you don't need the alpha. But if you, I mean, if from review you don't think that they've adequately captured or taken care of, or you have ignored these leading indicators that David mentioned, then the alpha kicks in. Now the alpha itself so that's just I didn't just add that to what the Eda said. From what you're saying, we've not really seen that with African businesses, but based on the question that they're asking, if your business is exposed to that and you've looked at this, you've talked to the sales guy, you've talked to the operations guys, and you feel that this will impact your volume, will impact your margins, and you've modeled that in there, you brought those lead indicators, then you don't need alpha. But if from talking to you, these are clear present issues that you are going to face, and you've done your model based on historical numbers, then you will need the alpha to take care of those the timing and your ability to achieve the forecast you are putting there.
Maybe if I can also add to that, looking at the question, is
Okay.
I think always when you are trying to build a forecast, you're doing your best estimate. Now, if as a modeler or forecaster, you go really conservative and you've maybe taken more like the worst case scenario, then I would say it would be overly punitive to further add an alpha to your discount rate. If you've, however, taken a realistic point of view, I do believe that there's still an enhanced degree of uncertainty. And you then could justify an alpha, maybe not a large one, but there's still more uncertainty than before when you don't know what's about to happen. If I go back to what we were looking at in March, April, and May of 2020, when COVID was new and so many businesses were uncertain, we were, in fact, at that point, bringing in, even on realistic forecasts, a small additional alpha for forecasting risk because it was just more uncertain. As you start to get more information, you've got more certainty as to how this is going to play out, that alpha could fall away. But I do believe that there is, even with realistic forecasts, you can justify a small additional alpha just because it's a more uncertain environment.
Thank you so much for these perspectives. All too soon, we will be drawing the curtains on this discussion. Before I invite Heather to give us the closing remarks, let me just go around the room, starting with Rashid. Rashid, from all the discussions we've had so far, what is the key takeaway for you from this? Then I'll go to David and then Golanhan. What is the key? Maybe if you have more than one, that's fine.
No, I think what he has said is that, business still tend to go on, and we cannot look at a short time alone, right? In the life cycle of a business. So if you just look at 2-3 years alone, right, it can be cloud, the bigger picture. So I did paint the challenges of working in West and Central Africa, probably also maybe it's applicable to the rest of Africa, but these regions still offer huge opportunities, right? And from a valuation perspective, when you look at the long term and you just don't look at the challenges and prices, then it probably provides a balanced view. And that's why that's one takeaway from here, which aligns with my position in taking risk around the sub-regional minding challenges, whether it's Trump tariff, whether it's policy inconsistencies, the opportunities remain. Thank you.
Thank you so much, Rashid. David?
Yes, I actually 100% align with Rashid, as in it's a long-term view. In the short term, all sorts would happen, right? I mean, presidential terms are usually 4 years for a reason, right? 4 years and probably 8. So at the end of the day, things will change. I mean,
I don't think that's applicable in West Africa, but let's continue.
Okay, yeah, that's true. Well, but and who knows? In America, it may not be. I mean, they may turn that rule. I'm hearing some things in the grapevine, but let's leave it at that. So yeah, have a long-term view, just like Heather said, right? Look, we've had blows. I mean, as I said, exchange rates, that's the worst tariff ever. But we're here. So we are resilient, but let's also look at the positives as well. How can we take advantage of this? No matter how terrible things are, even in COVID, people were making billions, right? COVID, that's a single major event. People made billions there. So there is a silver lining somewhere. Try and find it.
Thank you. There is a silver lining. Bolanha, your takeaway from this?
I think my takeaway is the ability of Africans, despite challenges they're facing, to be creative and just look that in spite of all this turmoil and confusion, there's just money to be made. And I think, I mean, you can see that in the fact that businesses that ordinarily, I mean, the businesses are still resilient and they're still there, will survive and weather through these challenges as well, because they've taken that long-term view and the ability to quickly adapt and change and strategize based on whatever it is that they face.
Thank you so much. Agility, being able to respond to any external, shocks it's a key to success in this environment. Thank you so much. Heather, I will yield the floor to you for you to conclude the discussion and give us your final remarks. Thank you so much.
Thank you so much, Evans. And thank you. I'd really like to extend my thanks to all of our panelists. I feel personally more optimistic after this discussion than I did at the beginning, because I think if I go back to Rashid, as he's highlighted in his speech, ultimately there is an impact on growth, on employment and investment decisions. And we can't ignore that, but we do need to be agile. We need to look for these opportunities. If I think back to what Wale was sharing with us, yes, there are risks. There will be inflationary pressure, and we need to innovate. And especially when he started taking us through the opportunities, I think that we mustn't focus only on the risks. He especially highlighted the potential for Africa to benefit from reconfigurations of supply chains as one of the areas that I think could hopefully bring us more business rather than less. Balahan, thank you so much for your input on valuations. And I think we've just reiterated now that long-term view is key. Long-term view with your forecasts, long-term view with your discount rates. When we look at multiples, we've always needed to make sure that we have got comparable companies, whether it's listed companies or transaction multiples. And there's been points that we would always look for: size, jurisdiction. Ultimately now, tariff exposure is another critical one. And that's where your pre and post tariffs, whether it's looking at a market cap, whether it's looking at a transaction date, it's a key trend that we need to take a look at. David, thank you so much for your insights. I think personally, I'm so happy that this session has been recorded, because I want to go back to that checklist that you shared with us, because I think it's invaluable to show all the different areas of a business that you need to consider, and also the interrelationship between them. I think for everybody, it's critical. What you've highlighted is to run scenarios. It's not just about one version of the truth. It's about potential scenarios, interrelationships between inputs, and a deep understanding of the business that will be critical to getting it right. Also, working capital, it's always been key to manage if you want to protect value, now more so than ever, with the impacts on supply chains and inventory. And I think also a call to action for all of us of how do we become a low-cost destination for the world so that we win out of this. So I really feel, as I said, so optimistic after hearing about all the opportunities, and I really do hope that it has been just as valuable for our participants. I see that from our poll that we've already seen 60% of participants seeing tariff impacts, 40% not yet. But I hope that this will have equipped you, if you haven't seen it yet, to be ready and maintain that vigilance. So I would like to thank you all for your time and hope that you will join us for future webinars. Thank you also to the team in Nigeria who came up with this concept and pulled together all of our valuable speakers. Hope to see you again soon.
Thank you so much, Heather, and thank you everyone for participating. Enjoy the rest of the day. Thank you. Bye-bye for now.
Thank you, everybody. Bye-bye.